Welcome back to In the Harbor. I'm your host, Jason Johns, and today's episode is brought to you by Diag Partners. Whether you're hiring or looking, visit diagpartners.com. Now, welcome in to our guest. This is your third time.
It is.
All right, this is our first trio, but I thought it would be helpful to kind of have an overview of the markets. We have Rich Consul joining us from Bankers Edge Advisory, a boutique investment bank. And what would you say your specialty is?
We really help deal makers complete deals. You know, you buy a $100 million company, you bring $20 million to the table. We help raise the other $80 million to complete that transaction.
Excellent. And then background-wise, you have degree in finance and then a master's in financial engineering?
Yeah, which is just a fancy way of saying a lot of schooling to help outperform the markets.
I'm sure you were going for your PhD, but then decided against it.
I literally was.
Yeah, I was joking.
and then you know, Wall Street or being in the financial markets pays really, really well. And ConocoPhillips had bought a paper from me during my graduate school, and literally that was like, okay, well,
I'm going to do this now.
I'm going to do this. It's a lot more profitable than being a teacher.
It certainly is.
Yeah.
Well, last time we had you on, we talked about a game you like to play on Sundays called, I coined it the Weekend Five, where we go over 5 markets, kind of what's moving them over the course of the week. I thought that'd be great framing as we get into today. So if we think about the 5, dollar, energy, stock market, 10-year, and gold and silver.
Yeah.
So why don't we kick it off with the dollar? What are we seeing there?
Yeah, I think the dollar has done some very interesting things, right? We have to look at individual currency pairs when we're looking at the dollar right here, right now, because if we're looking at broader indices, the dollar is basically flattish, right, for the year. But if we look at individual currency pairs, it tells a completely different story. And I think this is really something that bears following. One specific one that I would draw a note to is the Canadian dollar, right? Canadian dollar versus U.S. kind of trades in, call it a 90 cent to 120 or 110 market over the last decade. We are now at 140. So it takes $1.40 Canadian to buy $1 U.S. dollar. That's the weakest number that we have seen in decades, right? Decades. And unlike the euro or the pound, it's not at the high side of kind of a market range. It's through the high side of market range.
Through the high side.
Yeah. So I think that is an interesting one. And then take our neighbor to the south, Mexico. Peso keeps rallying, right? So the peso is really strong against the dollar. We're really weak, and then CAD is really weak against the dollar. So what's going on there? And I think understanding what's going on in that currency market tells you a lot about what's going on in broader global economy. Well, Canada's in a recession. Our neighbors to the north are in a recession, yet we're about to print 3.3% GDP, and the Canadian economy is about 85% dependent on the U.S. economy. So how can we be growing at 3.3% yet they're in a recession?
In a recession.
And it's a lot to do with kind of the trade issues between Trump and Carney and Trump and Trudeau before Carney. It seems as though...
Well, and Carney came from their central bank, right?
The England central bank as well, right? He was a governor at the Bank of England. So not just a Canadian central banker, but a UK central banker. And that's one of the premier central banks in the world, obviously, the UK. But if you look at it, he seems like they want to crash the trade car into one another. And, you know, I think currencies are really reflecting that. So I think you're seeing basically countries that are trying to find a way to work with the United States through kind of these tariff unwinds and tariff, rejiggers seem to be doing quite well. And then the countries who seem to want to kind of play cute or fight and put up additional barriers, they're really hurting from a currency perspective.
So who's going to blink first is the question.
I think we have all the cards. I really do. I don't think the Canadians have any cards in this. Like, you can't just when 85% of your domestic product goes across the border, you just don't find a suitable replacement overnight. Whether that's Canada, whether that's China or the EU, neither one of them seems to have an interest in taking 85% of the offtake from the Canadian market. So I think the Canadians are really, really in a pretty precarious position.
Oh man,
Yeah.
I haven't thought about that when you look at just North America, so
Yeah.
Mexico to Canada.
Yep.
Very interesting. Now let's talk gas prices because they've had a lot of movement. we obviously know the reason why.
Yeah. So I don't think there's really anything to say other than what's in Trump's mind and what's going on in the Department of War, right? It's one of the few times as kind of a trader in that market or having traded that market that, you've got no insight, right? You've got no insight whatsoever. The only things that you can really say are, what are my guide rails, right? What are my ranges to the upside and to the downside where I need to now start paying attention to, right? I think $100 to the upside is that high side range that we need to pay attention to, but I don't think we're going to crest over that. Like we did just a little bit around the war, we're trending back up into that direction, but I think generally speaking, I don't think we're going to sustain over that just because if anything happens calm, you've got, like we saw, oil down $20 in a week, right? So it's hard to push
one announcement,
oil.
one tweet, and oil will come down.
And it'll come down. Yeah.
So national average on gas price, I think, is right around this week, 409.
Yeah.
We started the year at 281.
Yeah.
So meaningful move, and of course, it hasn't been just one direction. It's been a little up and down as we get the tweets coming in.
It is, but the thing is keep in mind we're still well within tolerable ranges. If you go back to 2023, gas was, I think, peaked out at 426 during that time. So we haven't even got above some of those high inflationary prints that we saw in 2022 and 2023. So I think in the scheme of things, still okay for the consumer. It's something more sustainable at higher levels.
What do you think if we think the upper range, $5 is probably where it gets challenging?
Where it gets challenging? I don't know. I can tell you this, even at the current price right now, it doesn't seem to be affecting the restaurants too much, right? We see it at peripheries here and there, but like you go out, what do you see? I see a lot of people having a lot of fun and spending, hundreds of dollars to go see Morgan Wallen.
Yeah, and reservations are still hard to come by in the restaurants. To your point, so people are out and spending money.
The death of the consumer is something that that have been talked about for 2 or 3 years now, and I think we've talked about it a couple times since we've been on. It gets down to consumer consumption, and consumer consumption gets down to jobs. It gets down to productivity, and then it gets down to pay increases. Well, unemployment's 4.2%. Productivity is off the charts, so we can continue to pay those people and hire more. And then number 3, real wage growth is starting to pick up again, right? So when you have those 3 things, consumers generally aren't savers; they're spenders.
Right.
So you put more money in their pocket, they spend it, and when they spend it, the economy goes up.
So as we move on to the next category, the stock market, we
Sure.
use the S&P 500 as a barometer for the U.S. market. If you took everything out of the equation, it's been a great year.
Yeah, what do we look for on an annual basis? 12% returns. Well, let's just strike the nav right now and walk out the door for the year.
Exactly.
Because I think that's essentially where we're at on the S&P 500. And then, again, we rolled into this year. Yeah, we go into the Iran war. We get a nice little dip there, and I think we were literally in this chair at the bottom of that market. And I'm telling you the same thing I'm going to tell you now. The economy gets down to the consumer, right? And we just walk through kind of the dynamics that drive the consumer. But at the end of the day, markets follow the pull of gravity of growth, right?
Right.
And if the consumer's growing, the economy grows. And where does the market usually follow? It follows that gravitational pull of wherever the growth trend is going. So where's the stock market going? Tell me what's going to upset the growth aspect of it. I don't see it right here, right now, when JOLT numbers, which is job openings, just popped up again, right? So, I mean, this is a great economy. Lots of jobs, upward pressure on wages, but within a controlled inflationary manner, and high worker productivity. I mean, it's kind of a Goldilocks for corporate earnings and for consumers.
I mean, just looking at the last 5 years and what the market's done, I guess we'll strip out 2022, but
yeah,
looking at the past, it almost seems like we're in the melt-up phase of a bull market.
Yeah.
At the tail end, we'd have to be close to the tail end. So, what's the catalyst that breaks the camel's back?
I mean, it's a really good question. I think some of the issues around these hyperscalers. So when you think of the numbers around the hyperscalers, what is it? $800 billion is going to be invested in kind of data centers this year.
That's just from the 4 main hyperscalers.
Correct. Yeah.
So then there's the ancillary suppliers. It's probably over $1 trillion.
It probably is. Yep. And on a $30 trillion economy, give or take, essentially it's almost 3 points of GDP. Well, what is the second quarter looking to track at? In that 3.2-ish range. So if you were to take the hyperscalers out of it, growth might be flatlining, right, from that perspective.
Right.
So I look at it and say, could be the big upset is, and we've seen some bond auctions in the public markets start to tail a little bit, right? People are starting to choke on how much debt is coming to market to finance the expansion of these data centers. I think that could put a little bit of a slowing mechanism, but I'm not sure it goes from 3 points contribution to 0. I think it more goes from 3 to 2, right? But I think that's one aspect of the growth engine that we need to kind of follow. The second one is to the point that you were bringing up. What is that gas threshold that really breaks? Is it $5? It's somewhere, I think, above that number, right? We saw $5 a barrel in 2008, right? Inflation adjust for where we are, and that's equivalent to like, like almost $8. So I think the number that really breaks the consumer there is much higher. It's probably like $7. So I don't think it's a concern.
Well,
so
let's hope we don't get there. Seven sounds outrageous.
7 sounds out, unless you're in California, it might be cheap.
Yeah, that's true too.
Yeah. So I think the stock market looks good. I think the risk is still to the upside. I think the pain trade is to the upside here.
All right.
Yeah.
Well, let's get into yields, because yields have been a more interesting story.
Sure.
Especially over the last week. So if we look at the 10-year, I think it's up 65, 70 basis points on the year. Mm-hmm. Just 10-year yields. I think a decent amount of that came in the last week.
Yeah.
What is that telling us?
I think there's just more concern about the war than anything else, and that this war continues to kind of drag out and be more prolonged than the original, 4 to 5 weeks, I think was the original kind of statement. And the problem with war and the benefit of war, right? So what are the positives and benefits? Take the death and destruction out of it. The positive of war is it's a big driver of GDP. So you want another contribution to GDP, just keep on creating war, and you produce steel, you produce bullets, you produce all these things that go into manufacturing that drive the economy, right? So war is typically good for the U.S. economy, as draconian as that sounds. The flip side of war is it creates instability in global markets, as we're seeing in oil. Well, that oil shock is inflation. Inflation shock upwards, we have to compensate in the form of yields, long-term expectations that inflation is going to be higher, and as a result, as a bond investor, I need to have more inflation compensation.
Right.
But I think there's another aspect, which is we are looking at a situation where government debt deficits are really high. We've already seen it in the yen. Like, one of the reasons that the yen is really sold off is, while they used to have 1% on the 10-year is now, almost double that, right? In Japan. If you look at England is basically teetering on a recession, and yet yields are going up. Why are yields going up in these other locations? It's because budget deficits, debt to GDP, and at some point we just no longer kind of want the debt at those levels, and we have to ratchet the yields up. I think that's
the
happening
ECB
here.
just hiked, right?
They have to,
Yeah.
right? Into a recession. Like if you look at the EU, they almost need the Ukraine war to continue on. If it weren't for the Ukraine war, what was it? VW just laid off 100,000 manufacturing workers in Germany last month. 100,000 in Germany.
Oh my gosh!
Right? Like that's a meaningful number, and it's not just VW, and it's not just Germany. It is across Europe. They are. If you take the Ukraine war out of it, I think they would truly be not at a 0.5% GDP growth, which is where they're at essentially right now. They would be in the negative range, and yet they're raising rates into that.
Right, which is the inverse of what you'd expect.
So why do you have to do that? You have to do that because we're having trouble with financing the bonds, so we have to kind of incentivize people with higher interest rates. But the other part is the continued wars are also inflationary, right? So they have to do that as well to get it over the inflation rate. It's a double whammy. So I think yields have some pressure to the upside on the back end of the curve. I'm hoping in the United States that we find a way to kind of keep it where they're at 3.6%. Because if you think about yields, what are yields really supposed to do? They're supposed to clear. What do I mean by clear? Match buyers and sellers, or lenders and borrowers, right? Because what is an interest rate? It's what we as lenders and borrowers get together and trade, right? For me lending me your money. Well, we have $1 trillion of excess capacity in private equity. We've got about $1.2 trillion in excess capacity in private credit, and that's with the gating, right? And that's with the pulls out. And then if you look at excess capital at the banks, by a tier 1 calculation, it's almost $1.5 trillion. So we have almost, call it $3.5–4 trillion of excess liquidity here in the United States, just across those three avenues. When you have that much cash searching for lending and investment opportunity, that's typically a recipe for where interest rates need to go down, not up. Right? That's number one. Number two, you typically don't want to hike into what the Fed has always talked about with when gas prices go up. Gas prices and food going up are always considered transitory factors, right? We don't cut into transitory factors and we don't hike into transitory factors. Why? Because when oil and food goes up, what happens to consumer discretionary spending?
It goes down.
It goes down over here, right? So if we hike into that, yeah, we bring the oil prices down from a demand perspective, but we also are crushing the discretionary spending as well. So it's a double whammy on the economy to hike into transitory inflationary effects. So I think that's one of the things that we have to monitor, is that I think most people believe Warsh is going to stay anchored at this 3.6 for those two factors that I said, the transitory effects you don't want to hike into, and then number two, just how much cash is in the system, would say yields need to go down. But I think the market is pricing in the long-term kind of inflationary risks on the back end.
Well, and let's think about that, because when we started the year, I think they had it at almost a 0% probability of a rate hike in 2026.
They had two cuts baked in.
And now it's, I think, a 90% chance of at least one hike between now and year end.
Yeah.
33% in next week's meeting, which I think puts Warsh in a difficult place. Obviously, you don't want to be hiking rates into a midterm.
Yeah. I mean, you don't want to be hiking into a midterm, but the other part is, and we talked about it a little bit earlier on currencies. Japanese yen is under real strain. Canadian dollar is under real strain. What is one of the best ways to alleviate that strain as a central banker is, if they're raising rates, you don't even have to cut. Just keep them on hold. Because what ends up happening is, if one country is increasing interest rates and we're either staying flat or going in an opposite direction, it'll help relieve pressure on the currencies. And we'll typically see the currencies kind of revert back to mean.
Right.
So I think if you're trying to alleviate some of like the currency issues that we were talking about earlier, just on some of those best way to do it is you hold still, and you let them rise. And that's what they're kind of doing. So I'd expect no action, almost as a currency relief, right, to the rest of the world.
Right, and we don't get the forward guidance we got under Powell, so
yeah,
we kind of have to wait for the data to come out, and guess don't know what they're thinking.
Yeah.
Last one, and then we'll get into it. Gold and silver, and I think that's an interesting story because it's really a tale of two years. You look at what gold and silver did last year versus this year.
Yeah. Blow off top, right? I think is what we saw. Going into last year, silver got to 120. You had gold that got to 5,600. Where's silver now? It's literally halved, right? It's just inside of $60. I think it's 59 and some change or something like that as we sit here today.
Yep.
And then gold, it went from 56. Is it 4,100 right now? Somewhere in that range, or just around there. So we have seen a meaningful kind of blow off top here and a rationalization back of those prices. I would just generally say, I think given some of the macro forces, if we get back to a settled solution in Iran and we get back to kind of what the rest of the world needs to do, right, and what we need to do, I have to imagine gold and silver have an upward trend to them. I think this is a great opportunity to be buying. It's like kind of like when Bitcoin went up to $100,000, yeah, and then fell back down to whatever the level was. Every time it halves like that, that's a good opportunity to kind of dip in if you haven't had exposure to it. And I think in this environment with the uncertainty that the world is living in, I think you need to have.
I think just looking at price action, not even fundamentals. Just it's obviously going to be at the extremes when you see something like that. That's probably a good entry point.
Yeah.
Well, and I want to pause and bring you a message from our sponsor. And we want to take a second to thank our sponsor, Diag Partners. We've actually worked with Diag directly at Rock Harbor, so we know firsthand they deliver. If you're running a company and have a seat to fill, or you're a professional thinking about your next move, these are the people you want in your corner. Placements from analysts to executives done with speed and discretion. Check them out at www.diagpartners.com. All right, now we have the weekend 5 out of the way as a kind of a framing for the conversation. But one thing I'd like to get into a little bit, we recently had the SpaceX IPO, which was, by all accounts oversubscribed.
Yeah.
And we saw a lot of price action immediately.
Yes.
And now we're well below the IPO price of 135. What is that saying? What are your observations around that?
I think it's been happening for probably the last 10 or 15 years. What is happening over the last 10 or 15 years? Most of the value that is being extracted in these IPOs is being extracted in the last 12 months before they go to market. And we're seeing basically private placements before they go public, extracting out all the value. So it's like almost like if you're not part of the club on the institutional side, and you can't get like some type of allocation pre-IPO in the lead up, in the years lead up, you get to cash out on the IPO, right? And I think the SEC really needs to kind of look at some of that, because they're juicing up the pre-IPO price with all this kind of private money that's coming in. And then when it gets to IPO, it's just way overvalued. And I think that's what's happened is the private market basically extracted out all the value and then dumped into the public market. Because who doesn't in this world right now where we just sent astronauts around the moon for the first time in decades, and we have a plan to actually get back to the moon, who doesn't think advanced rocketry is going to be something that is
like the first time in 50 years, which blew my mind.
Yeah.
On that side of that far away.
Yeah.
I couldn't believe it's been that long.
Yeah. I just want to know, did they play Dark Side of the Moon while they were in the pods?
I mean, that would have been a layup. I think they
should have, right? Exactly. So
what I think is interesting, let's look at Facebook. So Facebook IPO'd 2012, May of 2012 at $38 a share. traded up on the day, like we saw in SpaceX, and then just consistently fell.
Yeah.
I don't think it retraced that gain for over a year.
Yeah.
Where it was above the IPO price at $38 a share.
Yeah.
I mean, today you look at Facebook, it's trading at 600 something a share. Obviously, the company's changed a lot. It became Meta and a lot of growth there. So it's not saying it was a bad investment.
I think it's the same type of thing, right? It's this issue with SpaceX. We saw it in Meta. We've seen it in a whole host of like go-go IPOs, right? They have this huge run up in value in the last kind of 2 rounds of funding before they go into IPO. And essentially those last 2 rounds is where all the gain kind of is made for a lot of the private investors. So when they go to actually do the IPO is just way overvalued. Typically, it used to be when an IPO came to market, we did it at a discount to market multiples to get you to kind of want to come in.
Want to come in, right?
Right? These stocks now are now multi-billion-dollar market cap companies on day one, not sub-billion-dollar. Right. It used to be if you were over $1 billion, you were a unicorn.
Right. So that changes the equation because you look at SpaceX, we're at $1 trillion, $1.7 trillion valuation, the largest IPO ever.
Yeah.
Which is just nuts to think about.
Just nuts to think about. So that's my point, right? Is that these no longer are, billion-dollar companies. These are in SpaceX case now trillion-dollar companies. Well, how do you get that trillion-dollar valuation? It's a whole lot of private investors who put money in and I would say juiced up kind of the valuations. And then they don't even have to sell much. They can just sell a small nugget. And then there's so many people who want to get in and it creates this frenzy. And what happens? You get the huge pop up, but where's the additional marginal buyers? Once everyone gets in, all the private investors have already been in and now you got the public in. Where's the marginal buyer coming from? And now we have to trade off.
Well, and we're going to see, too, because a lot of the insiders haven't been able to sell yet.
Yeah.
So we'll see continued pressure on the stock price.
You will.
In the near term.
Yes.
I mean, that's not prognosticating what's going to happen in the long term, but in the near term, you're going to have significant pressure.
But since they have already been in, they're not marginal buyers, right? They're marginal sellers once they finally can get past the 6-month restriction period of time, right? But once the public gets in, it gets down to the markets are where is the buyers and where are the sellers, and once everyone is carded in, you don't have any additional marginal buyers, which means the stock has to come down. And I think that's essentially you just get all the value in the pre-IPO, and then you get the mania, and then the trade-off. To your point on Meta, as it relates to SpaceX, I think at some point down here, you'd want a long-term position in the stock if you believe, rockets are going to be the next, thing, right? Or all the different things that go into SpaceX.
Well, and everyone likes rockets, so.
I mean, jeez, who doesn't? That 4th of July was just a month ago, right?
So absolutely. An article I read this week that I found interesting as we talk about private markets would be the amount of capital in zombie funds. Do you see that just being more noise piling on to the, all the negative headlines?
You're talking about like on the private equity side?
Private equity, private credit side. And the zombie fund valuation, I think it's, 54, it's a big number. 1.16 trillion in PE assets currently trapped in aging funds past their intended horizon.
Man, so on the PE side of things, I think we are at the early innings of a great rationalization there of not everyone is a Carl Icahn, not everyone is a Wilbur Ross, not the old kind of PE icons who really kind of define the industry, right?
Right.
Not every PE fund can create compelling value for investors. So yes, I think there is a lot of trapped money there. There are a lot of you see a lot of GPs, general partners at some of these firms all of a sudden disappear. Well, it's because their portfolio that they were managing is sucking wind. Right. So best way is to kind of loosen the overhead load is to get rid of the expensive GP guy who brought that bad investment into the portfolio. And we see that pretty extensively. I would say fast forward from here 5 years from now, I think the PE market generally is probably smaller. Private credit wise, I'm not sure it's going to be smaller. I think we've talked about this in the last session that we did back in March. I think the issues surrounding private credit are much to do about nothing.
Right, and we did talk about that. And actually, our last podcast episode with Joe Zeidel, I asked him in our Q&A, what's one asset class you would own for the next 10 years and never look at it again? You know what his answer was?
Private credit?
Private credit.
Yeah. Yeah.
And so a lot of what you're saying now, too, is...
Yeah, and I was like back then, right? At the end of the day, private credit, think of private credit. What is private credit? Private credit is lending that basically has a higher leverage point or is unbankable. Okay, so what does unbankable mean? Well, banks only give you money if you don't need the money. So like you've got tons of cash flow, you've got tons of assets, and you're like, okay, how much money do you need?
Well, and if you think about that, though, the private credit market has really been burgeoning along with tighter restrictions on bank lending.
Yes.
So they're going hand in hand. They're a complement to each other.
Correct. And we saw it really accelerate after Silicon Valley Bank went down in 23, right? So from 23 to 25, literally, and I can't remember the exact numbers anymore, but I believe deposits in the United States, inflationary driven, went up 18%, yet lending flatlined at the banks. So what does that mean? Well, banks basically take your deposits and then lend them out. So when deposits go up by 18%, but your lending doesn't go up, you actually become under leveraged. So your leverage goes down and you become more liquid. Okay.
Right.
Well, to your exact point, deposits went up 18%, lending went flat, yet the economy continued to grow. So where did that lending go? It went into private credit, right? So the question would then becomes, did private credit make bad loans? I think they made some bad loans, but I think it's at the margins. It's not at
right. Don't throw the baby out with the bathwater.
Totally.
Because of some bad marks on bad loans and
yeah. And the high level ones that kind of triggered the original conversation, right? The tri-brands and I forget the other one that went down.
They were fraud.
Fraud. Yeah. Now big frauds, right? But generally speaking, when we kind of look at like think of Ares. So Ares has the largest portion of their book is in SaaS. Okay. What is the one thing everyone's talking about?
SaaSpocalypse.
SaaSpocalypse, right? Because AI is going to no longer... we're no longer going to need SaaS software services, right? Because AI is going to kind of take over that. So that area kind of hit that concern hit private credit and people who had that. What have we seen? It's kind of much to do about nothing. We didn't really see a huge pickup in default rates. Point in fact, C&I lending defaults are running at 1.3%. You know, in the broader economy, 1.3%.
Right.
It did not go up at all this year. so there's no defaults. So where is the concern about private credit if the defaults aren't there and the underwriting, I would say, while at a higher leverage point than you would see at the banks, these are not stupid people, right? They usually either are always lending against assets or lending in a first priority position, or even in a worst case scenario, they're still collecting 65 cents on the dollar in a rationalization.
Well, and I think that's where, for the general population, a lot of the confusion comes because you hear private, you automatically think there's going to be more risk associated with it. So the idea that this is traditional lending that has historically been done by banks, the banks are no longer doing.
That's right.
I think that's how it should be framed. Obviously, with the headlines, the gating on some of the funds, I've seen today there was an article how a lot of funds are changing their marketing to say, no longer say semi-liquid. So set expectations that way.
I'd like to know how many lawsuits were filed around that word.
Oh, absolutely.
But I think the other aspect is there's a yield difference. So if you go to a bank and you get a bank loan as a corporation and you fit into the nice, neat, clean bank lendable box, it's called your banking loan is like SOFR plus maybe 300. Okay, so you're all in sub 7% yields right now.
Right.
If you're in the private credit marketplace, you're typically SOFR plus 500. So you're getting about 200 basis points more yield premium to be in private credit. Well, what is that yield premium there for? It's actually for the higher risk in private credit, right? So there is, it's not a perception that it's higher risk. It is higher risk,
or
right?
the illiquidity premium.
And the illiquidity premium, but community bank loans are still pretty illiquid as well. They're all illiquid, but generally speaking, that additional yield premium is for kind of this higher expectation of losses because you're underwriting to a higher leverage point, okay, in private credit. So, but the question is if the difference between the bank default is 1.3 and private credit is like 1.6, so it's only 0.3%, but I'm making 2 points more in yield, I'm a winner.
Right, you're happy with that.
I'm happy with that.
I will. So thinking about the underwriting standards, if we talked about the major cases that hit the headlines and the fraud with Tricolor and the other ones, was something missed from an underwriting and structuring standpoint, or did they just need to allocate capital and they thought that was the way to do it? Or
it's a really good question. I think there seems to be some dialogue around what are called UCC filings. So when I give you a loan against assets, I'll file a UCC form with the government that basically says I'm first lien on your assets. And everyone in the world can now see, because of my UCC filing, that I have that lien on that asset. Well, when you start doing kind of smaller, say, subprime auto lending, every time you file one of those UCC issues, it costs you money. And, you know, it's usually you have to have a lawyer draft it. And even if the lawyer is got an expeditious process, it might be $1,500. So on smaller things, you may not do a UCC. And my understanding is because there wasn't a UCC designation put on some of the assets that were backing those loans,
they were able to pledge
the collateral
assets multiple
twice.
times. Yep.
So that's so what did we learn? I think it gets down to the blocking and tackling of lending, gets down to I need to make sure that my claim on these assets is articulated and known to the world, and that that helps me to ensure that you don't double pledge your assets. But that's still nefarious, you know, bad boy behavior by the executives over there. They knew what they were doing.
Yep, absolutely. All right. I would think we already talked about chances of a rate hike, so I had that on here. So I think we can table that discussion as we, you know, just going back to the hyperscalers. So if we look at Microsoft, Amazon, Meta, and Alphabet, that's where we're getting that almost $800 billion in spend in 2026.
Yeah.
What does that look like as we go into 2027?
Like I said earlier, I think some of the bond issuance to fund these hyperscalers has slowed, which is to say the appetite for funding continued bond issuance here in that space seems to be waning. I would have to imagine if you can't finance it because the bond market is getting to the point that they no longer really want to participate in these deals without a meaningful higher yield compensation for it, I think the inevitable is it's got to slow down, right? The market's basically saying, we're choking here. There's no more paper that we're going to allow. And when you don't have the financing mechanism for it, you can't do it.
So, and you were saying that, you know, if it adds 3 points, maybe we go to 2. That's kind of the range bound we're in.
Correct.
So.
Yep.
I would be curious how a lot of the, in the local municipalities, how a lot of this plays out.
Yeah.
Because there's the political risk. And there seems to be broadly, not just about the data centers themselves, but this anti-AI movement that's growing. You saw the college campuses.
Sure.
Everyone, you know, booing when an AI speaker would get up. I mean, what do you see there? Is that a real issue for the data center build out and the continuing evolution in AI?
I think it's really interesting because there's a lot about the protests that are going on around these data centers, like that, not in my backyard. And being in the Detroit area, and having grown up here my entire life and growing up downriver, well, what did we do downriver? We had a bunch of factories. We had big, heavy industrial factories. And it got down to, not in my backyard. I don't want this anymore. The problem with having that philosophy and having that thought is, I don't want to live next to the factory, and I may not want to live next to the data center because of the hum and some of the other kind of issues that come around being around those data centers. I still want the jobs that it creates. Because if I basically say not in my backyard, well, that means they're going to put that factory or that data center somewhere else, and those jobs are going to be over there.
In my backyard now.
Yes, exactly. Exactly. So I think the question happens, we have to be kind of thoughtful in this as consumers and say, if I see a data center going up, maybe I don't want to live there. But I think we still need to think about it from the jobs perspective and say, if I say no to it, then that job is going to be taken over here, right? It's going to find someplace to go. And would I rather have that job available for my neighbor and my family, or would I rather that job be available for someone else's neighbor and family? I'm kind of selfish and say I'd rather have the job.
I mean, it's really a political tightrope, too, when you think about states want to have the jobs. They want the job creation.
Correct.
So if there's too much, hand-wringing over placement of the data center, they could lose out entirely on what that means to the local economy.
Well, I mean, look at what AOC did in New York with the Amazon distribution, right? What was that? 15,000 jobs because she was playing politics. Well, I mean, I'm not sure. Maybe New York has so many jobs right now that 15,000 is like, no big deal.
Drop in the bucket.
But I doubt it, right? 15,000 is a lot.
Yeah. And in her district, I think it was.
In her district, right? So I look at it like this is I think we have to kind of think of it as economic progress often comes with some negative downsides, and we have to assume some of those downsides to be able to feed our family. It's really first world problems that we're like, I don't want to be close to the factory, or I don't want to be close to the data center because it bothers me. Well, you know what? If you've ever gone to rural town USA, the train coming through is an incredible annoyance. Have you ever seen My Cousin Vinny? And you've ever stayed in a small city, right, along one of those old rail lines? When that freight train comes through, that is a real shake the earth, thing for that community, and it's routine. But you take that rail.
Well, it's quaint and charming when you're visiting.
Yeah.
Once you live there, it's a whole other story.
But you want that train coming through, right? It's like when the highways went through. If you didn't get the highway,
you were going to be obsolete.
You were going to be obsolete. So I think we need to think of these like as people and members of our community. We need to think about this. Yeah, we may not want the noise of the highway. Yeah, we may not want the rumble of the train. Yeah, we may not want the stink of the factory or the hum of the data center. But we don't want to be obsolete and make our community obsolete because we chose to give up on those jobs that went somewhere else.
Right. Well, I think it's a great time for a break, especially since we're thinking about jobs, to mention Diag Partners. And another message from our sponsor, Diag Partners. Hiring the wrong person is expensive. Diag Partners exists to make sure that doesn't happen. We've seen it firsthand at Rock Harbor. They move fast, they're selective, and they get it right. Whether you're hiring or looking, don't leave it to chance. Visit www.diagpartners.com. So when we go back to private credit and thinking about, cash flow lending or asset-backed lending, what are the differences there and the nuances that probably aren't getting talked about enough?
Yeah, so when we think about private credit, it's really those two areas, asset-based and cash flow lending. And it sounds on the surface of it pretty self-explanatory, right? What is asset-based lending? Well, I only give you a loan up to the quantum of your assets, those assets being accounts receivable, inventory, and other property, plant, and equipment that I will lend against. And I don't lend you dollar for dollar for that of that valuation. What I do as a lender is I go and get an appraisal report. And basically the appraisal report says, if I were to liquidate this company in 90 days, right?
Right. So it's going to be lower than what you probably could get because it's a fire sale.
It's a fire sale, right? Mm-hmm. I'm not even going to give you 100% of the fire sale price. I'm going to give you 85%. So your asset coverage in an asset-based loan is typically, if you've got $36 million in assets, maybe the fire sale value is $24 million, but I'm not going to give you 24. I'm going to stop the line at 20, right? So I've got plenty of assets to cover any default. So I think there's no real big concerns from my perspective on asset-based lenders in the private credit area. If anything, I think that's the way you want to be positioned. On the cash flow side of things, I think there could be some issues there, right? So what's the difference on that? Well, cash flow lending is if you make $10 million a year, I'll give you a multiple on your cash flow. So if you make $10 million a year and I say I'm going to lend at 3x to that, I'll give you up to $30 million. So you make 10 and I'll give you a loan up to 30. And then I expect you to pay me back over over a 5-year period of time. But I'm not lending against any assets. And you might be in an asset light industry like, I don't know, office, right? Like secretarial pool, right? What is the assets of a? Let me step back on that. A great cash flow lending example is going to be like Diag Partners. Diag Partners, what do? They help hire employees for other people, and then they send those employees out to their respective client.
Right.
But generally speaking, what is the property, plant, and equipment or the assets of a recruiting company? It's not much. They might own their building, but they're asset light. Most of those companies probably lease their office space, so they don't even have the office as an asset, right? Phones and computers are cheap assets, right? So you don't really lend against those. But that you might be making $10 million and still have a $30 million loan. But if you go into default, what ends up happening? You have no assets. So we go into receivership and liquidate you out. You've got nothing as pledged against that loan. So instead of having an asset coverage on the liquidation, I end up getting like 0 recovery rate in a liquidation. That's why I'm more concerned about cash flow lending than I am about ABL lending in the private credit world. So when I think of private credit and I'm allocating money, give me assets.
Well, and let's think about the roofing roll-ups.
Yeah.
That we discussed earlier. When you think about asset-wise,
yeah,
it's not a lot of assets.
Not a lot of assets. I mean, they've got a car, right? And they've got hammers and they've got, some basic equipment, but it's not like property, plant, and equipment. It's not like a 3-story press or rolled bar steel, right, as inventory, or a huge, 60,000 square foot manufacturing facility that are like the assets that I'm pledging. Typically in like an HVAC or a roofing or some of those kind of business services, you maybe got some trucks, but that's not going to get you much from an asset-based lending perspective. So you have to do it on what's called a cash flow loan.
Well, in HVAC, there's going to be ongoing revenue with existing customers. With roofers in particular, I mean, what is a roof rated for?
20 to 30 years, right? And some of these guys are giving you lifetime warranties on it. So you get these situations where, like roofers down in Florida, a lot of PE went into that segment in 2023. What happened in 2022 and 2023? We had a lot of hurricanes. What happens when a hurricane comes in? It rips the roof off, and if you're in one of the velocity zones. Well, you rip the roof off, and now you've replaced it for that 20 to 30-year period of time. So PE went in there and bought a lot of these roofing companies at the high side of their earnings after a bunch of hurricanes.
Right, of the opportunity in front of them.
Correct. And now what we have seen is not only have we seen fewer hurricanes the last 2 seasons, so wind damage replacement has gone down, but now all the roofs that are there are now good for 20 or 30 years. So just general replacement activity has basically petered off. And a lot of those guys who did cash flow loans there are now going into some type of, workout. And the bank has no interest, or the private credit company has no interest in working out with you because you have no assets, right?
Right.
I'll let you work out of this if you have assets because, generally speaking, I've got assets there. I'll let you kind of extend and pretend a little bit because worst case scenario, I can always liquidate your assets. When you've got when you've got no assets and it's just cash flow, and your cash flow is going down, the longer as a lender that I take to basically cut this off, the less recovery rate I get. So they have no interest in working with you at some stage. And what we're seeing is some of these roofing companies, some of these HVAC companies, some of these kind of asset-light go-go areas that have been funded by a lot of private credit, they are taking some losses. That area of the private credit market and the cash flow side it would be something that you should be at least acknowledging when you're investing there.
Well, no, and I think that's a good way to think about it. Obviously, asset backed from a risk standpoint versus just the pure creditworthiness and credit quality of a company is going to be much different.
Yeah.
You have something tangible that it's tied to.
That's right. That's right. And you see that in the yields. You'll see it like a ABL lender who was even doing lending for a distressed borrower, but they're pledged against all assets. That's still like a SOFR 400 to 600-ish area, and on a distressed. If you did a cash flow loan on someone similar, you may not be able to get it, and then if you can get it, the yield's probably going to be another 2 to 3 points higher on top of it.
Right. So now we're at 7 to 10 over SOFR. Over
SOFR, right? So now you're talking about 13 and 14% lending, and so when we think about that cash flow, the lenders know this, right? The private credit guys understand this risk and they price it accordingly. But, that is a concern in my mind.
Yep, I would agree. Well, I appreciate you, as always, taking the time to sit down with us.
Yeah.
Do you have any last thoughts you want to share? Anything if we look at the market going forward from here?
Yeah, I think the last thing I would say is the market always gives you the pain trade. So if you really want to take advantage of the markets and you really want to understand where the value is, generally do the opposite of what everyone else is doing.
Right, and that's an adage that has worked well for a long time.
It is. Yeah. It is. So when we kind of look at this world, I think generally speaking, the economy is doing a lot better than the headlines would seem to indicate. And I think a lot of people who are following the headlines are being misled or being led astray from some of the underlying kind of economic opportunities that are there.
All right. Well, thank you for sharing your wisdom with us and observations on the market. Always a pleasure, Rich.
Always a pleasure. I'm glad we can always do this. Cheers.